The global economy has slowed. A hesitant and uneven recovery is projected over the next 2 years, with only modest growth forecast in the OECD area. The United States and Japan are expected to pick up gradually, but the euro area will remain in recession until early 2013 and then grows slower than other regions. A quicker recovery is expected in emerging economies.
The world economy is not yet out of the woods. There are several risks. In the US, if policymakers don't agree on spending cuts and tax measures, they risk bringing the US economy down a fiscal cliff into recession. In Europe, if the long-standing problems of the euro area are not finally dealt with, there is a risk of a new financial shock which could prompt a global slowdown.
The euro area crisis has eroded business confidence and damaged the financial system. Prior to the crisis, borrowing costs were fairly similar across the euro area, with interest rates in most countries close to those seen in Germany. While rates in France have remained close to the German benchmark, borrowing costs in Greece, Portugal, Spain, and Italy have risen significantly since 2009.
Higher borrowing costs are a symptom of the wider need to restore confidence in monetary union. Progress towards a full-fledged banking union must be accelerated, and bank capital must be strengthened in Europe. Decisive policy action could prompt a return to growth sooner than expected.
Sound public finances are essential going forward. Future fiscal consolidation efforts must address inequality, which varies widely across the OECD, from more unequal countries like the United States and the United Kingdom to Denmark and Sweden. OECD analysis illustrates how the mix of policies to achieve a 3% of GDP budget consolidation could impact inequality. A reduction in government welfare spending tends to worsen inequality, while a similar consolidation through targeted tax hikes could actually lessen inequality.
There are 50 million unemployed people in the OECD area. Governments must take into account the social consequences of the crisis. The composition of fiscal consolidation matters. Governments must look at growth and equity. But the crisis has shown that we cannot go back to business as usual. We need new sources of growth. We need new approaches to economic challenges.